lesson? Example 3, if I'm not mistaken, isn't it? Any of you there? Which slide that we discussed last time? The last one. Any of you? Which slide? 26. Wow. This one, direct methods and indirect method. This is the last one, yeah? Okay, just repeat once again. Yeah, relate with your item that make a difference between your cash flow, normal cash flow, and then you have a consolidated cash flow. So cash flow, consolidated cash flow statement. Okay, cash flow statement. And then cash flow statement is the same. We are using the same standard, which is 107. Okay, the difference here is consolidated. So we can only prepare a consolidated financial cash flow statement when you have a consolidated profit or loss and also consolidated financial position. From this consolidated financial position, this information we use to prepare a consolidated cash flow statement. The format of consolidated cash flow statement is same as a cash flow statements. Okay, so we are referring to MFRS 107. Other things, one thing that's an extra things that we need to include in a consolidated cash flow statement here is a 4 item, which is related with the NCI. Okay, the second item here is related with the investment in associate. The third item is related with the acquisitions of subsidiary, and then the fourth item here is a disposal of subsidiary. Okay, we'll just repeat again your NCI here. So NCI here, the thing that relate with the NCI here is the two things, which is due to the profit for the periods and also the dividend paid to the subsidiary, to the subsidiary, paid by subsidiary to the NCI. So maybe you need to record this one. Okay. So the difference here is in terms of the NCI. So for NCI here, NCI is going to two things that we're going to affect the NCI here is relate with the profit for the years and also shares of profit by the NCI and also a dividend paid to NCI, dividend paid by subsidiaries. Shares of profits here is not related with the cash, so we don't have to bother about that one. Things that we need to focus here is on dividend paid because dividend paid here going to involve a cash outflow. So we're going to focus on a dividend paid. So for the dividend paid, to calculate a dividend paid, say this is a formula or the T account, the simple way to prepare the statements here to find the amount of the item that we're going to allocate for the NCI associates and the acquisitions of subsidiary and disposals here, we're going to prepare a T account. That one is the most simple one to find the amounts here. Or you can use a mathematicals here, the using the plus minus here. But the simple one, I'm going to teach you using the T account, how to find the figures here. Okay, so for the NCI here, dividend paid by subsidiary to NCI is calculated by this working using the T accounts here. So for the NCI accounts here, the credit side is a balance, and then the amount of NCIs here is balance brought forward. Amount of NCI here, NCI will be increased. We start with the beginning balance, and then going to be increased due to the profit. Okay, profit that they are shares by attributable to NCI and also the acquisition. That one will be increased. And then the amount of NCIs is going to be reduced due to the NCI dispose of the subsidiary and also the dividends paid. So two things that are going to reduce. So the dividend paid, the credit side you have the debit side for here, the dividend paid here is only a balancing figures here because you know the ending balance, you know all others information. So the thing that you need to calculate here is a dividend paid. So dividend paid here is a balancing figures, balancing figure. Okay, we tried it, but these examples we don't have to calculate one because it's already given. So we had said that A have a 70 70% in B, so means that NCI has another 30. So, and then this is the statements of comprehensive income for both A and B. Yeah? Okay, for A and B, we're going to have a profit after tax, and then this is the shares of the NCI, 26.25. Okay, and then the other ones you have B here. B here is a subsidiary, so B paid dividend 12.5. Okay, from this 10.5 here, with this dividend is going to be received by parents and also by the NCI. So parents going to receive 70% and the NCI another 30%. Yeah? Okay, the amount, the things that are going to affect the cash flow statements here is the dividend paid to the NCI. Yeah? So the dividend paid on NCI here is put it under financing activities. So remember that we have operating, investing, and financing. Operating is anything that relate with your operation. So it's most of the item which is that generate revenue and expense. Together with revenue and expense and changes in working capital. So working capital here is referred to the changes in the current assets and current liability. Okay, the other ones here is investing. So investing relate with the long-term asset, including investment in subsidiaries. Investment in subsidiary, JV, and associate. The one is under investing. Okay, financing here is related with a long-term liability and also equity. So for this one, NCI put it under equity section. So when the NCI is under equity sections, the sections that are going to involve here is a financing activities. So we put it under financing activity. Dividend paid to the NCI 3.75. Where to get this one? The total amount paid here is 12.5. Dividend paid times with 30%. Okay, you make sure that the operating the activities that you put is in the correct one. So NCI is under financing because NCI is a part of equity. Yeah? Okay, and then the other one is investment in associates. So investment in associates going to affect here. We have two things here. The first one is shares from the profit, shares of profit from associate, and then the other one is dividend received from associate. Yeah. Okay, shares of profit associate and dividend received. Yeah. Okay, item one, the first item here, shares of profit here is no cash items, non-cash items, so it does not bother with the cash flow statement. But it depends, it depends. If you are using the indirect methods here, you need to make an adjustment to your profit, operating activity. If you are using the indirect method. Okay, for the shares of profit, even though we said that there is no effect on cash, but if you prepare the cash flow using indirect method, so the shares of profit need to be minus here because when we want to calculate the profit for the period, you already add the shares of profit by associate. So one, we make an adjustment here because shares of profit here, there is no involved of cash, so we need to minus this one. Yeah? Okay, so now I'm going to look at the dividend received. So the dividend received here is result with the inflow in cash. We're going to receive that one. So we're going to include in the cash flow statement. Yeah? So this is how we're going to calculate the dividend received from the associate. So associates here is your investment. So investment balance brought forward should be debit side. So this investment is going to be increased due to the shares of profit. And then if you have an additional investment, okay, going to increase. Okay, and going to be reduced due to the disposals and also going to be reduced if for a dividend received. Yeah? The amount of dividend received here. So this is the one that you're going to calculate because you have information about this one. About this one you have information. So we want to find the dividend received. So the dividend received here is also a balancing figure. The thing that you need to know here, which side, debit side or a credit side. Yeah? Okay. So this is how we're going to calculate using a T account. Yeah? So we have these examples here, and then you hold 20% in C. So you have a shares 20% in C. So this C is your associate. Yeah? Okay, focus on this one. Shares of profit in associate. If you look at here, when you want to calculate the profit before tax here, you already include this amount. So include this amount. So remember that this amount is not a cash item. So we need to exclude. When we prepare the cash flow statement using indirect method, so indirect method, we start with a profit before tax. Okay, before tax. So we are using 642.5. So this profit before tax is already include the shares of associate profit. So already include. So this item is a non-cash item. So non-cash item, so need to minus shares of profit. 17.5. Minus, why we need to minus? Because this is not a non-cash item. So this is a non-cash item. So we're going to have this one. Okay, and then the dividends is paid by C here. C is your associate, so we're going to allocate to A here is 20%. Yeah? So the dividend received here. Okay, so this is how when you prepare using the indirect method. So because we make an adjustment from the profit before tax, your profit before tax here will already include the shares of profit. Okay, but this shares of profit here is said as a non-cash item. So we need to minus it. So we're going to minus here to find the cash flow from operating. Yeah? So this one is under operating, yeah, because we put it under, because we make an adjustment for the profit. Yeah? So need to minus this figure. And then for the cash flow from the investing here, you're going to have a dividend received from associate, put it under investing. Why investing here? Because your associate here is a part of the investment. So investments here is under long-term assets. So dividend received that you have here is 20% times with 12.5. Yeah? So it's already given. So you don't have to prepare the T account for this one. Okay, just already given. So you need to just time with 20%. Okay, said that we need to lessen the amount of profit before tax with the appropriations of the associate profit amount because the profit is not in cash or cash equivalent form. So this is what we have. We need to minus. Okay, dividend received from associate will increase the group cash. Okay, going to increase the group cash. Thus, it will add up in the cash flow statement. Okay, dividend received here going to increase the cash, so we need to add, but we put it under investing because that dividend will receive from your investment. Yeah, so investment is a part of a long-term asset. Okay. So if you have anything you voice out, yeah, maybe I need to cannot see some of the things that you're putting in the chat box. Okay, proceed with the next one. Our direct method. So for direct methods here, we don't need to show the operating part because we only consider for the investing because there is no adjustment for a profit. Yeah? So we only report for the investing activities only. By using a direct method, you don't have to bother by the appropriations of associate profit in the profit before tax amount because we don't make an adjustment to the profit. Yeah? Okay. You can directly add the amount of dividend received from the associate under the cash flow investing activity. So if you look at here, if you have a dealing with the associate, one you have the indirect method, you're going to have two items, which is operating. Okay, operating here is related with the minus of shares of profit, shares of profit. And then you're going to have the investing here for the dividend received. But if you're using a direct method, you only have investing for the dividend received. So two different methods that we are using. And then we move to the next one, acquisitions of the subsidiary. So acquisitions of subsidiaries here is when a company acquire another subsidiaries. Okay, when you acquire another subsidiary, automatically the group's total assets and total liability will increase, but the group cash will decrease. So when you acquire another company, assets and liability will increase, cash will reduce. Cash will reduce. Okay, the standards mentions that the aggregate cash flow arising from acquisitions of subsidiary companies should be presented separately and classify as a cash flow from investing activity. Put it under investing activities. Okay, aggregate amount of cash paid to the acquired of the subsidiary company should be reported in the consolidated segments of cash flow as a net of cash or cash equivalent acquired. Okay, so what is an aggregate cash flow? Aggregate cash flow here is, let's say that you want to acquire a subsidiary. Let's say you paid, okay, purchase considerations that you paid here, purchase consideration. Let's say you paid 10,000, for example, 10,000. Okay, you want to acquire company B. Okay, you want to acquire company B. In company B, in a segment of financial position, in company B, there is a cash of 1,000. So to find the aggregate cash here, the purchase consideration should minus cash in B. In B here is your subsidiaries is 1. So now your aggregate cash here is 9,000. So once you want to report in the segments of cash flow under investing activity, the one that you report here is only 9,000, not this 10,000. Okay, 9,000 after you minus the cash that is available in that subsidiaries. Okay, and then one more thing, when you have acquisitions of subsidiary, assets and liability will increase, cash will reduce, and then you may create a goodwill also. So be careful with this one. Yeah. There's 3 things we're going to involve here. Assets liability increase, the cash will reduce, and then goodwill also going to be increased. This one is related with the acquisition. So be careful with this one. So, and then when you have the acquisitions here, you need to provide additional information in the notes to the account, how much you pay for the purchase consideration, and then the portion of purchase consideration discharged by means of cash and cash equivalent. Let's say you pay 10 million. From that 10 million, cash 7 million. Shares capitals 3 million. So the amount that you need to report here, so this one you need to disclose in the notes to the account. Said that paid 10 million, from the 10 million, cash is 7 million, and another 3 millions come from shares capital. So, okay, this is the amount that you need to mention. The amount of cash and cash equivalent in the subsidiary acquired, like previous example, let's say you have 1 million in subsidiary B, for example. So you need to mention that amount. The amount of others assets and liability in the subsidiary acquired, and then need to summarize by measures category. For example, fixed asset measures category. So you need to decide or disclose the amount of others assets and liability in the subsidiary that we acquired. So this is the main thing that you need to disclose in the notes to the accounts. Okay, the aim for this presentation is to distinguish the cash flow arising from the acquisitions of subsidiary from the cash flow from others activities, meaning operating, investing, and financing. Okay, we try to look at these examples here. A acquired another subsidiary, okay, 80%. Okay, which a cash purchase consideration. The purchase considerations here is cash. Already using cash here 1 to 5. So they paid cash 1 to 5 during the year 2017. So this is the balance sheet of the. So the balance sheets of the, you need to focus on how much cash that we have here. So the cash that you have here is 12.5. So the purchase considerations is 1 to 5, all in cash. Cash. So you need to minus the cash available in D. Okay, cash in D here is 12.5. So the difference that you have here is 115 here, 112.5. So this one is called a cash aggregate cash. Aggregate cash. We're going to report in the under investing activities. Okay, McGill mentions that the NCI is measured based on the percentage of net asset. What is the purpose of giving here? It is to calculate for a goodwill here. Okay. So now you look at here the total net assets here. When you total up your net assets here is these two figures. So you're going to have 150. Yeah? And IA here is 150. You can total up either your asset here 250 minus 62.5 minus 37.5. At the end you're going to have 150, or you total up these two figures. So net asset is 150. And NCI here, NCI based on percentage of net asset. So NCI has 20%. 20% time with 150, so NCI going to have another 30. So the total purchase considerations here, the one that you pay here is 125 plus NCI 30, so you're going to have 155. Compare with a net asset. So the net asset that we have here is 150. So you're going to have a goodwill of 5. So this goodwill going to add the amount of goodwill. Let's say you have another subsidiary. Previously you have 10. For example, goodwill previously, say for example, A plus B plus C, the goodwill that you have here may be 10. So now the total goodwill become 15 after you have a goodwill from the new that you acquired from D here. Yeah. So this is actually the calculation. Actually, we are done for the calculations. This is what I'm going to calculate for the aggregate cash. Aggregate cash, the purchase minus the cash availables. And then for the goodwill here, you need to find the total asset and then compare with the SUI and then the NCI. So you have a goodwill here. So goodwill here going to increase. So you need to add with the goodwill, the existing goodwill that you have in that company. Okay, for the cash flow statement, okay, above asset means that all the assets that you have here, this asset is this assets and liability here, including goodwill. So the new one is a goodwill. Liability and CI need to be adjusted to a respective account. So to prepare the statements of cash flow, so you have the investments here, the total aggregate cash here, the aggregate cash is 112,500, need to be presented under investing activity. So acquisitions of the subsidiary. Why we put it under investing here? This is because of your investment in subsidiary is a part of your long-term asset. So you're going to transfer it or put it under investing activities. Okay, so done with examples, illustrations 3. Okay, so we move to the next one. The last part, the last item that make a difference between consolidated and cash flow of statement of cash flow and the statements of cash flow itself. So the last one is a disposal of subsidiary. Okay, when a company disposes its subsidiaries company, automatically the group total assets and total liability will decrease, but the group cash will increase. So when you dispose here, assets and liability will reduce, cash will increase. At the same time, you're going to have a gain on disposals. You may have this one. The same thing, the aggregate cash flow arising from the disposal subsidiary should be presented separately as a classified from the cash flow from investing, put it under investing. So still aggregate. The aggregate amount of cash receipts of sale consideration should be reported in consolidated statement of cash flow as a net of cash and cash equivalent disposed of. This is the term that we use, dispose of. Okay. Okay, so additional information here that you need to disclose: total disposal price, portions of disposal price received in cash and cash equivalent, the amount of cash and cash equivalent in the subsidiary that we dispose, the amount of other assets and liability. The same things that you need to disclose like the one that you have for the acquisitions. Okay. So the same thing, we're going to distinguish the cash flow arising from disposal of the subsidiary from others cash flow activities. Okay, so try to look at these examples. Example 4 here. Okay, for this example 4, okay, A Berhad disposed one of its subsidiaries, E, during 2010, and A has 80% in E. Okay, cash consideration, dispose all. Dispose one means that they dispose all. Okay, dispose all. Okay, the cash considerations agreed was 150 for the disposal. This is what you have at the balance sheet date. So look at here. So you dispose here at 150. From the 150, you need to look at what is the amount cash available minus cash available in E. So cash available in E here is 12.5. So the cash that you're going to receive here or you're going to disposal aggregate cash here will be 137.5 here. Okay, so this is what you have here. So it said that at the same time we're going to have a gain on disposals. Okay, so this is what we already calculate. Okay, and then you need to calculate your total asset. Okay, the total assets that you have here is 250 minus 100 here for the total liability. So net asset 150, NCI portion here is 30. So the disposal price here is 150 minus your net assets here is 120. Net assets here is 80 times with 150. Yeah? So you're going to receive gain on disposals here is 30,000. So this is remember that for a disposal we need to assets and liability going to be reduced. Cash going to increase. Okay, and then you're going to have one item here is which is a gain on disposal. So how to report this one? So all asset including goodwill need to be adjusted and NCI also. How are we going to report this one? So we need to report only the amount of aggregate cash, which is considered as net of cash disposed of. So you're going to put it under cash flow investing. Why investing here? Because dispose a subsidiary. A subsidiary is your investment. Investment is under long-term asset, so put it under investing. So debit a dispose debit. Sorry, put it under investing. Put it as item here is a disposal of a subsidiary. So the amount that we use here is a aggregate cash. The aggregate cash that we have. So be careful when you dispose, when you acquire cash that we consider here is the amount which is an aggregate cash. Okay, for a disposal here, we have two types of disposal. The first example that we have in example 4 here is a total disposal. Okay, total disposal. And then the other one is a dispose. You dispose partial disposal. So partial disposal. We dispose partially subsidiary, not involving a loss of control. So means that you dispose subsidiaries here, but a parts only. And then you still have a control. Means that the parents still have more than 50%. For this one is more on the movement in equity. Movement in equity. Okay, so for the cash flow arising from the changes in ownership interest in the subsidiary that do not result in the loss of control shall be classified under financing activities. Okay, why this one is financing activity? So once we have a movement in the equity here, it's going to involve your NCI. Yeah? So NCI here is a part of your equity item. So you're going to put it under financing. Yeah? So this is a argument why we need to put it under financing because it relates with the NCI. Yeah? So the cash proceed from the sales 20% of the 80%. So parent have 80% and then sold 20%. So it still have 60%. So 60% means that there is still a control. Yeah? Okay. So parent shows the equities here and the equity interest 20% for 5 million. Yeah. Okay, cash proceed 5 million. Shares of net asset in a subsidiary was 4 million. So means that from the amount here 5 million proceed and then so the NCI here is 4 million. So we're going to have a gain of 1 million. Yeah. Okay, shares of the net asset in NCI here is 4 million. So we're going to have a gain here. This gain going to recognize directly in the returns profit. So gain here, you're going to have a positive movement. Yeah? When you have a gain here, you're going to have a positive movement. The positive movements we're going to recognize in your RE only. There is no cash involved for this one. Yeah? Only RE. The cash here is only this items. Yeah? Okay, so for cash flow from financing activity, put it under financing. Yeah? Previously, disposal, if that one is 100% disposed, put it under investing. If that one is disposed but you still have a control, put it under financing because it relate with your NCI here. So cash flow from financing activity proceed from decrease in stake in a subsidiary 5 millions. So this one adjustment for the returns earning. So for the returns earning, we have a positive movement of 1 million. So positive movement 1 million here, going to be under a credit side. Yeah? So RE here for the RE. So this one is dividend paid. Yeah? Dividend paid. So balance brought forward. Okay, profit attributable to owner plus gain. And then we're going to have ending balance. So dividend paid here is a balancing figure. So we're going to use this T accounts to find for a dividend paid. Yeah? Okay, for the NCI, also dividend paid to find dividend paid for the NCI here. Balance brought forward, profit attributable to NCI, shares of the net asset. So means that the NCI increase an additional shares, additional share because parent sold to NCI. So we're going to increase the NCI allocations of shares, additional share. So 4,000 shares. So the NCI here, the credit side, balance brought forward, profit, additional shares, and then the debit side here is a dividend paid, and then the ending balance. Dividend paid here is a balancing figures. We use this one to calculate for the dividend paid for the NCI. Previously, in the examples 1 here, is dividend is already given. You don't have to calculate. So how to calculate the dividends paid here is using this T account, NCI, this one. Okay. So I think that is the end of your notes here. So do you have any questions relate with your examples for the items that we need, an extra item, additional item for the consolidated financial cash flow statement? Okay, for you're going to have the first one that you have here is for the NCI here. Okay, for NCI you have a dividend paid. Dividend paid, put it under financing, because it relate with the NCI. The second thing we have associate. Associates here is a dividend received. So dividend received, put it under investing because it's related with your investment. The third one is acquisition. Okay, execution of subsidiary. So this one is under investing, but this one should be aggregate cash. Okay. The fourth one you have disposal. For disposal, you have to be careful. Disposal 100% dispose, put it under investing. Also aggregate cash. But that one dispose but still have a control, put it under financing. Okay, finance. Okay, so that is what we have for the cash flow. The note is seem easy, but the example is not as easy as what you have in your notes. Okay, have you go through the example? Have you read the examples? Any of you? Or try to do that one? Or you are too busy with your tutorials? Which one? Have you go through on that one? The notes, the example that you have there. What do you have the example for? You can find the examples, the questions. Are you still there? Okay. So have you tried that one on the examples? At least go through, read some things that you have in the examples. Okay, so can we proceed with the examples here? Can we try to do that one together? Okay, because maybe you get that question, you don't know what to do actually. Okay, try to look at that one together. Okay, so this is what you have for the consolidated statements. Okay, balance sheet and income statement for Sejahtera for the year 2019. So 2019 here. So the questions here is to prepare the cash flow statement. Okay, using direct and indirect. Indirect method and direct methods. Indirect methods and direct methods here is only for the operating activities only. Okay, so for indirect method, we're going to adjust your profit before tax. Okay, direct method says is a little bit complicated. Okay, because we need to find every single items. Okay, you have the formats here. Okay, for the formats of a direct methods, you can refer to slide. You look at that one slide for a direct methods here. Which slide that we have for a direct methods? Okay, direct method is slide 9. Yeah? So you can refer to slide 9 for maths here. And then indirect method here is slide 11. Yeah? The difference here is only for the operating. Yeah? Okay, so we're going to, when you have these kinds of question, before you start to answer the cash flow question, you need to analyze information that we have here. So the information that we're going to use, assuming that we are using the indirect method, we're going to use this item. Okay, profit before tax. And then we're going to make an adjustment here for profit before tax, assuming that we are using indirect methods here. Indirect method, profit before tax, we need to plus non-cash item. Plus or minus, depends. Okay, so in this one, to get a profit before tax here, if you look at here, the operating profit plus gain and then plus shares of profit. So these two items here is not a cash item. So when you want to prepare the cash flow statement, you need to minus these two items because they are not non-cash item. Kenapa nak minus? Why you want to minus it? Because we already plus here. So we need to, for the adjustment here, we need to minus it. Okay. So that is what you have. So this is a dividend information that you need to know. The NCI, the tax expense. Okay. So this is what you have. Okay. That is your income statement. Okay, now for the balance sheets here. So for the balance sheet, you need to analyze every items that you have in a balance sheet. Yeah. Okay, the fixed asset. So means that if you look at here, there is a changes in the value. So this is your previous year. This is your current year. So if you look at here, there is a difference between the previous year and the current year amount. So once there is a difference there, it means that there is a changes in the value. Also means that maybe they're going to have an for example, the fixed assets here, maybe they're going to have an acquisition, they bought a new asset, or maybe they dispose a new asset. So if you look at here, the last year and the current year, there is a reducer. If you look at here, there is a reducing. How much should you have reducing here? You have here. You analyze item by item, sir. Reducing by 49 here. Okay. Then for your investment in quoted shares here, so this one is related with your investment. There is increase. Maybe you bought some investments here, a new investment. In associate, there is an increase here, increase by 15.5. Maybe shares of profit. Okay, intangible asset, there is a reducing there by 66. I should have 66. Okay, so every single item you need to analyze. Okay, inventory here increase by 35. Account receivables also increase by 14. Marketable security also increase by 55. Cash and cash bank balance here also increased by 134.5. Okay, just analyze the item first. Account payables increased by 12. Okay, accrued reduced by 5. Tax payable reduced by 1.5. This one increased by 10. Bank overdraft here increased by how much you have here? 15.5 here. Okay. So analyze the item. So if you look at here, the thing that you need to focus is about this one, current asset and current liability. Yes, so current assets and current liability, we said that when there is an increase in a current asset, we need to minus. Decrease in a current asset, we're going to plus. Increase in a current liability, we're going to plus. Reduce in a current liability, we're going to minus. Okay, so we try to prove this one. Let's say your account receivables. Account receivables, before this, you have a balance of 10. Now, at the end of the year, you have a balance of 5, for example. This is beginning, this is an ending. Examples. So you have a reducing here. Reducing by 5 here means that the customer, okay, account receivable, make a payment. Okay, so once account receivable make a payment, it's going to increase your cash. So reducing here means that is going to increase your cash. So reducing, we need to add. Okay, so that is why you have the argument between why we need to plus or minus here. Okay, and then for a liability, we try for a liability. Okay, for a liability, let's say you have a loan. Okay, loan here, beginning 10. Beginning balance is 10,000. Ending balance, you have a balance of 7. So means that you have a reducing by 3. So reducing by 3 means that you make a payment. So reducing here, you need to minus. So we're going to payments here means that your cash will going to reduce. So that's why we're going to minus if there is a decrease in a current liability. Why we need to analyze current assets and current liability here? Because this one is related with your working capitals. Okay, when we use indirect format, these items is important. Indirect, because we want to look at for the indirect methods. Okay, we're going to use a working capital formats. Okay, so we already analyzed this one. The items here. Okay, the shares capital, no changes here. Return profit, there is a changes. NCI. So NCI here, there is also a changes in your NCI. So you can look at here, the return profit here. There is an increase by 242,917. NCI here increased by 8 here. And then long-term notes payable decrease. Okay, decrease here means that you make a payment here. Decrease by 112,917. Yeah. Okay, just analyze every item that you have in your balance sheet. Okay, then we look at the additional information. So it said that group operating expense for the year 2019 was 300. From that 300, which is include the impairment loss of a goodwill, depreciation expense for a fixed asset, and the increase in a doubtful debt allowance. So means that in your operating expense is already include the goodwill, impairments of goodwill, depreciation, and also the doubtful bad debt. Bad debt. So it already includes. So remember that this item is a non-cash item. Yeah. So non-cash item, when this amount is already included, means that for the adjustment, you need to minus this item. So we need to uh, so minus here means I'm going to plus that one. I'm going to plus back that amount. Yeah? Because when you calculate the operating expense here, we already include that amount. So we need to exclude that one. So it's exclude here means that you need to add back that amount. Yeah? So we need adjustments here, we need to add back. Kenapa kita nak add tadi? Sebab sebelum ni we already minus that amount. Yeah? Okay. So cost of goods sales, because we already include this one as a part of your operating expense. So remember that to find a profit before tax, okay, is your gross profit minus your operating expense. So in your operating expense is already include this item. So you're going to increase your operating expense. So your profit here will be lower. So to make an adjustment, we need to add back to this profit. Okay. Cost of sale was 156. Okay, 156 for this one for the cost of sales. Okay. And the interest income 2019 here is 25. Tax here for the groups, and then for the associate, this amount for group will be different. This one is for the associate. Okay, and then this one. Okay. On 31st December, Sejahtera sold 80%, entire of 80% means that you dispose all. Yeah? Okay, and then receive a cash considerations of 19,790. So cash that you receive is 19,790. Okay, and then you receive that one 19,790 in terms of cash, and then 30,000 in terms of the third investment. So cash 19, and then you're going to have shares capitals of 30, yeah, 30,000. Okay, so we're going to look at this one. Yeah? So this is the net assets of the company. So for the net asset for the megah here is the one that you dispose. So you need to focus on this amount. Okay, so you need to minus 5,500, 4,500 to find for the aggregate cash. This one is cash in megah. Cash in megah. So you want to find the aggregate cash outcome. Okay, so you're going to have this one will be 86,290. So this is aggregate cash that we're going to report it in the investing activities. Okay, so the balance of goodwill attributable to Mega at the date disposal was 30,000. So this is the amount of the goodwill. So we're going to minus later on. Yeah? Cash and cash equivalent consists of bank and bank balance, marketable securities, and the bank overdraft. And the tax rate is 30%. Okay, look at this one. So the cash balance that we have here is consists of bank balance, marketable security, bank, and bank overdraft. So we need to find what is your cash. Cash at beginning balance. Beginning balance means that the cash in the year 2018. So it said that the cash here it has elements of marketable security, balance, and also bank overdraft. So we look at for the year 2018 because we want to find the beginning balance. Beginning balance that you have here. Marketable security 1 to 5. Okay, plus 63 from cash. And then bank overdraft, we need to minus 120.5 here. So we're going to have here the amount for the beginning balance that we have here is 67,500. Okay, this is your beginning balance. So ending balance that we have here, for the ending balance, marketable security 180 plus cash equivalent 197.5. Okay, and then minus bank overdraft 136. So the ending balance that we have here, check for the ending balance. The ending balance here will be 241,500. Okay, maybe I need some. Where can I drop this one? Okay, can I put it here? The ending balance that you have here is 241,500. Yeah, 241,500. Okay, now we need to compare ending balance and beginning balance. So beginning balance that we have here is 67,500. So the difference that we have here between ending balance and beginning balance, we're going to have 174. Okay, 174 here is a net changes in cash. So net changes in cash here is to find this figure is the cash from operating plus net cash from operating plus net cash from investing plus net cash from financing. Okay, net cash from financing should equals to 174,100. So actually, the cash flow statements here is will give you a clue whether your answer is the correct one. Once you find this one, you should find that when you total up. Okay, the first thing you calculate this one. So you calculate the ending balance and the beginning balance. Look at the difference. So the difference here is considered as a net changes in cash. So this net changes in cash, when you make a calculation for the operating, investing, and financing, you should total up these three items here. It should equals to this amount. Yeah? If you find the amount, let's say 150, means that there is something wrong with your calculation for the operating or investing or financing. Yeah. So actually it's guide you whether your answer is the correct one. Yeah. Okay. So you already analyzed this one. So now we need to prepare the statements. Yeah? Okay. So have you tried to prepare the statement? Any of you have a question, sir? Okay, so after we analyze, we need to prepare the statements. Yeah? Okay, so how are we going to prepare the statement actually? Okay, we're going to start with the indirect method first. Okay, so I just showed you the answer. But later on, we try to find where that figures come from. Okay. Have you tried actually this one? So this is on uh, how to answer for your cash flow statements. Yeah? Prepare. So we try to prepare that one together. Okay, so this is the one that I have here. Okay, just stop sharing this one for a while. Okay, can you see this one? The cash flow, the Excel file. Can you see that one? Okay, so now we try to look at the formats that we have here. Okay, we start with the indirect methods. Okay, indirect methods. Is it clear? See that one? We need to zoom this one a little bit. Okay. So this is what we have. Okay, so you are using the from indirect methods, yeah. So the titles for the company, Sejahtera Berhad consolidated segment for the year ended, yeah. Okay, you start with the cash flow from operating activity. Okay, so the cash flow from operating activities here we start since we are using the indirect method. So for the indirect methods here, I'm not sure. Okay. You use the indirect method, you start with the profit before tax, then we make an adjustment. Yeah? Okay, so profit before tax, based on the information given here, the profit before tax, remember that because the one that you have in your slide 40 here, the profit before tax is 513,310. And then we make an adjustment here. The adjustments here, the first one, in the profits here, we already include the shares of profit. We already because these two item why we need to minus because this one is already included here, so we need to minus here because there is no cash non-cash items here. Okay, so we need to minus shares of profit from associate, gain on the disposal of the subsidiary, and also impairment loss. Impairment loss we already minus previously. So previously we minus to get a profit. So now we need to add back that one. The same thing for a depreciation and also for a doubtful allowance. So all of these three items before this we minus, yeah. Before we minus, so now we need to add back. So now we need to add because there is no cash involved here. Okay, so you have here for the interest and bad debts allowance, and then the other ones you have interest income. So interest income here, informations if you refer here is information number 3. So the interest income that you have here is 25. So 25 here you need to minus here. Why we need to minus from the profit here? Minus from the profit here because interest income is not your operation, not from your operation. You just minus from the operation. So that's why you minus the interest income, yeah, 25. Okay, you're going to have a profit before working capital. So working capital here is before the adjustment for a current asset and current liability. Yeah? Okay, now we're going to adjust for the working capital. So, okay, for working capital, so you look at the increase in inventory. Okay, so the increase in inventory, where do you get that 71? Macam mana dapat 71? So this one, you need to calculate plus minus. Yeah. So increase in inventory. Macam mana dapat tu? Okay, any idea where to get that 71? Any of you have an idea of how to restore this figure? So increase in inventory. So if you look at here, your inventory has an increase by 35, isn't it? By 35. Betul? Mana dapat 35? Okay, any idea on how you receive to that the figures that 71? Dapat figure tu. Okay, you look at your inventory. So inventory, T account, simple. Okay, can I show you a T account here? The T account, your inventories that you have here, you're going to have your beginning balance. Okay, beginning balance here is the debit side. Okay, this is your beginning balance. Adjustment. Okay, for inventory account, I just show you based on the inventory account. We start with the beginning balance. Okay, beginning balance. And then 36. 36, where does 36 come from? This is the one that you dispose. Dispose 36, I remember that. You dispose Mega. So when you which company? I guess you dispose Megah. In Megah, there is an inventory of 36. So once you dispose Megah, dispose Megah, once of your subsidiaries here, assets and liability going to be reduced. So reduce here means that you need to dispose your inventory by 36, put it under a credit side. And then this is your ending balance. So ending balance 131. So altogether you have 167. So 167 minus your beginning balance 96. So you're going to have an increase in inventory by 71. How do you know that this one is increase in inventory here? Because there is a debit side. Is it okay with the first one with the inventory here? Okay, is it okay? Try to look at this one, whether you understand this one or not. Is it okay with the inventory? Understand or not? For the inventory. Okay, and then you try to for the account receivables. Account receivables, is it okay with the account receivables? Okay, let's look at the account receivables here. Okay, for account receivables, okay, we look at here. The account receivable that we have here, account receivable is your asset. So account receivable is your asset. So you're going to have here, this is your beginning balance, 44 of your account receivables, beginning balance, 44. Okay, and then you're going to have 27,600. What is this 27,600? Is the one that you dispose. Okay, and then you're going to have 28 here. What is this 28? This 28 here is the amount of your, what is that 28? It's the amount of bad debt. Yeah? Bad debt you need to minus because that bad debt going to reduce or going to reduce your beginning balance. Put it under bad debt here, and then you're going to put it under a credit side. Yeah? Why bad debt is a credit side? Because bad debt going to reduce your account receivables. Yeah? Okay, so this one is a dispose, this one is for bad debt, and then this one is your ending balance. So you total out here, you're going to have 113,600. So minus with 113,600 is a balance, and then minus 44. 44 here is your beginning balance. So you're going to have 69,600. So 69,600 at debit side means an increase. So increase here, we need to put it a minus, put it in a brackets. Okay. Okay, the next one, what you have here, maybe I need to reduce a little bit. Can you see this one? If I reduce that, is it clear? Is it okay with this size? Okay, yeah. A little bit right here. Okay, I guess now it will be okay. So we have done with your inventory, and then we also done with your receivables, and then increase in payables. Okay, another item here because we need to analyze all the assets and current liability. So your current asset, you only have inventory and account receivable. Both marketable, security, and cash here is a part of the cash balance. So we don't need to calculate for that one. Yeah. Okay, and then we look at the item for the current liabilities here. We have account payable, accrued interest, tax payable, dividend payables, and bank overdrafts is already a part of cash, so we don't have to get that things. So accrued interest here is related with the interest paid. So interest paid here is another part which is not under operation. Yeah, taxations payable also not from the operating, not under operations. Okay, we put another side. Dividend payables here is under financing. Yeah? Okay. So you look at the account payables here. So the account payable, look at your account payable. Account payables here is a credit side. So a credit side. So account payable, you have a beginning balance of 18. So this is your beginning balance of 18. And then 13 here. What is 13 here? 13 here is the one that you dispose, isn't it? accounts payable. Okay, this one is the one that you dispose. And then what is this 30 here? What is this 30? Okay, what do you have for 30 here? Account payable here. 30, what is that 30 here? Any idea on that 30? Okay. What is that 30 for? Balance. Yes, the ending balance. So you're going to have here is the ending balance. So the ending balance, you have 30. So altogether you have 43 here. 33 minus your beginning balance, 18. So you're going to have 25. Since this is a credit side, so the credit side here, you're going to increase. So going to increase in account payable means that this is increase in account payable is a big increase in your current liability. So increase current liability, we need to plus. So that's why we plus it. Okay, done with the items that we have here. Okay, so we're going to have cash from the generated from operation 544 minus these two figure and then plus this 25. So you're going to have this figure, and then we need to have interest paid here. So the interest paid here is a difference between the beginning balance and the ending balance, because we don't have any information related with the interest here. So you're going to have 20, 25 here. Okay, 25 here. Sorry, 20 here is the beginning balance. And then 15 here is the ending balance. So the ending balance is lower than the beginning balance, means that okay, ending balance is lower than the beginning balance, means that there is a payment here. Okay, payments here. So that's why we need to put it in a bracket as a payments here. So payments. Okay, interest paid. Okay, interest paid here, you need to look at the amount of income tax. So income tax here, tax payable. Okay, tax payables that you have here, we're going to have a balance. Balance here is 8.5. So this is a beginning balance. Okay, 137,193. 137,193 here. What is this amount? This is the amount of interest for the group, tax groups, yeah? Interest for the current year. Interest for the current year, for the year. Okay, 137,193. Item number 4, refer to item number 4. So you're going to have 137,193, interest for the year. Okay, and then this is your ending balance. So ending balance, the difference that we have here is 143 minus 7. So you minus 7 here, you're going to have 138, 138,693. So this one is debit side. So debit side means that you paid. So this is the interest paid. So you're going to have 555 minus 428 minus 5 minus 138, and then you're going to have 284,707. So this one is a cash flow from operating activities. Okay. Okay, done. So going to have that one. Now we look at the investing. Okay, for investing here, we're going to look at the interest received. So interest received, if you look at here, previously, you have the interest income here. So the interest income here is not a part of your cash flow from operating. It's supposed to be under cash flow from investing. So you need to exclude from operating, transfer it to the investing activities, because when you calculate the profit here, the interest income is already included as a part of the profit, but the interest income is not from the operating activity. So we need to exclude from operating, transfer that one to the investing activity, because interest is come from your investing activity. Yes, just transfer. So transfer this interest received here is transfer from operating to investing. So interest received 25. Okay, the disposals of the subsidiary we already calculate here. We only look at the aggregate cash. Aggregate cash that we have here is 86,290. Purchase of fixed asset. Okay, purchase of fixed asset here we need to calculate. Okay, we look at your fixed asset. Okay, fixed asset has a beginning balance, the debit side. Beginning balance here is a debit side, beginning balance. Okay, and then 46 here reduced by, okay, 46 here is from the disposals. Disposals of 86 is from disposal. This one is from a disposal. Okay, 46 here is from your depreciation. Depreciation. This one is a disposal. Okay, so you're going to have altogether 850 here. What do you have for 850? What is that 850? Where does that 850 come from? 850 here is a beginning balance, ending balance, isn't it? Okay, this is the ending balance. Okay, total up here. So 982 is your totals that you have for the credit side. So the debit side you have 89. So minus 89 here. So you're going to have an increase by 83. So increase by 83 means that you purchase. When there is an increase means that you're going to purchase. How do you know that one is an increase? Because this is to balance here, you need to have a amount in a debit side. So means that you need to increase this one. So means that there is a purchase. Okay, the next one you have dividend from associate. Okay, how to calculate dividend from associates here? Okay, so investment in associate, if you look at here, the investment in associate, beginning balance you have, this is investment in associate is your asset. So this is your beginning balance, 124,500. Okay, what do you have for 11,400? 11,400 is the tax for the okay, one. And then what is this 38 here? What is that 38 here? What do you have for that 38? Okay, the 38 here is a shares of profit. Okay, because shares of profit will increase the investment. So, and then this is your ending balance. So you're going to have here investment in associate. So balance this one, you have debit side 162. And then the credit side here, you need to have another 100. 100 here, since this is a credit side, this one will be your dividend received from associate, or dividend that going to be paid by associate, received from associate. So this is what we have 100. So, okay, so just proceed with the next one. Okay, so if you have a question after this, okay, and then we look at the financing activities. Okay, for financing activity is dealing with your equity and long-term liability. Okay, we look at the first one is payment for long-term notes. Okay, long-term notes. Okay, look at long-term notes. This is your liability. So this is your beginning balance. Okay, and then 130 here is your 134. Sorry, 134 here is your ending balance. 48 here is from the disposals. Disposal. Okay, so you're going to have here a debit side 64 to balance this figure. The debit side you have 64, 917. So debit side, when you have this one is a debit side, means that you need to make a payment. So payments here, we need to minus it. Okay, and then the next one is dividend paid to NCI. So dividend paid to NCI. So we look at the NCI amount. So NCI here is a credit side. So NCI has a balance. So this is the beginning balance of NCI. Okay, and then NCI also entitled for shares of profit. Share of profit for the NCI. Okay, how much you have here? Shares of profit for NCI. Okay, 37,800. Look at that one. Okay, NCI here. The 37 here is shares of profit from income statement. And then 186,220. This one, where this figure come from? Any of you? This one is your ending balance. 18620. Where that figures come from? Any of you? Any idea? Where that figures come from? This one. 18620. Any of you? Where this figure come from? 186. Let me help you. 18620. Okay. Where is this figure come from? Okay, this one is from the subsidiary that you dispose. Okay, dispose. We dispose here is 20%. 20%. Okay, this 20% from the asset. Refer back to slide. The one that you dispose here is 93,100. So the amount that you dispose here is from the net asset. Dispose 20% time 93,100 from the net asset of Megah. So share of NCI 20%. So 20% time with 93,100. So this one is the one that you dispose. Okay, so to balance here you have 11,180. So means that this one is a dividend paid. Okay, this is what you have, dividend paid by the NCI. Yes. Okay, and then dividend by parents here is a dividend paid by parents. So look at the dividend payables. So dividend payable, this is your beginning balance. Okay, this one is item that you have in the income statement. Okay, this is the ending balance. So at the end, you're going to have 74 dividend paid here. Okay, so you're going to have net cash flow from financing negative 150. So you're going to add operating plus investing and then plus financing, plus these three items together, it should be 174. 174 here is a net increase in cash, and then plus with the beginning balance, it should equals to the ending balance. Okay, so this is what you have. So you have try to look at this one and then prepare for a direct method. Okay, so any questions that you have? So even though the items is very simple, additional information is very simple, you need to analyze every single information that you have in the statement, both income statement and also for the segments of financial positions. So any questions that you have? So I'm not going to discuss with the direct method. So you try to prepare for a direct method. Just give you the answer for a direct method. Okay, the direct methods here, the difference here is only for the operating here. Only this item that make a difference for a direct method here. Direct method, the difference here is only for this operating activities here. The rest is similar. Okay, the difference here is only for this part. Only this one is a different. Okay, at the end the figure is the same. This one is same methods, the same things that you have here. The difference here is only for the operatings only. This is the same as indirect. The difference here is only for this operating only. So this is how we calculate the account receivables, inventory, payables. Okay, try to look at this answer and then try to prepare that one once again. Okay, and then so details, if you have a questions, we're going to discuss for the next class. So any questions that we have here? Any of you have a question, sir? It's not as simple as your notes here for this cash flow statement. So if refer to the previous exam question, is more on indirect methods. Make an adjustment for the profit from the income statement, and then we adjust the items. So any questions that we have for this one? So next class, we're going to continue with the direct methods. It's just this one for direct method. Direct methods here is you need to calculate the receipt. Okay, just proceed in a few minutes only. Okay, just receive a cash receipt from a customer. So for cash receipt from a customer here, we're going to look at the account receivables. We're going to focus on account receivable. So account receivable, the beginning balance that you have here, this is your 28. What do you have for 28 for account receivables here? 28 here is bad debt, bad debt allowance here. We're going to have a bad debt allowance. Yes, 28 bad debt allowance. 27 is the one that you dispose. Okay, and then 58. What do you have for 58? 58, the one that you dispose. So I don't prepare for that one. For the 58, what do you have for that 58? Beginning balance 18. This one is the beginning balance, bad debt, and then this one is your ending balance, ending balance that we have here. So the difference that we have here, 890, what is this 890? 890 is come from where? 890 is from your revenue or sales. Beginning balance, receivables here, beginning balance plus your revenue. Okay, revenue or sales is equals to bad debt plus the disposal and then plus the ending balance. So and then you're going to have here is a cash receipt, receipt from customer. And then to the suppliers here. So for the suppliers here, you're going to have two items here. It's related with the inventory and also with the accounts payable. Inventory is related with the purchase here. So we need to calculate the inventory. Inventory, this is your beginning balance of the inventory. Okay, beginning balance of inventory. This is the ending balance. Okay, and then 36 here is inventory that we dispose. Okay, dispose here. What you have for 156? 156 is the COGS. COGS. Okay. So the increase that you have here is 227. From this 227, we're going to transfer to accounts payables. So account payables, beginning balance of 18. So this one is a purchase of inventory. And then 13 here is the one that you dispose. And then 30 here is the ending balance. So you find that the purchase or you paid for the account payables here will be 202. So this is what you have. Cash paid for operating expense here. This one is given. I think the cash paid for the operating expense. Okay, said that. 190. Where do you get that 190 actually? This one is 300. 300 here is from your operating expense. Okay, minus 36 here is because of the impairment loss. Okay, loss that we have here. 46 here is a depreciation. And then 28 here is for the bad debt allowance. So you're going to have 190. Yeah? That is right. Interest paid, same thing. Yeah? Okay, and then tax also the same. With the direct, this one is also the same. Okay, so this is three things that you need to calculate. Cash receipt from customer, supplier, and operating expense. So this is how we're going to calculate that. Okay, the rest is the same. Investing and financing is the same. Okay, hopefully that you can prepare your tutorials. If you have a questions for the next class, okay, you are going to allocate half an hour for the questions on the cash flow. If not, we're going to proceed. I'm not yet decide what we're going to have for the next class. Either we discuss your tutorials 3 or we proceed with the foreign. I'm going to inform you a day before class. So any questions that you have here, try to watch again your recorded versions and try to answer your tutorial. If you have a question, okay, please, we're going to discuss again. So submissions of your tutorial are going to extend up to 19. Any questions that you have? Okay, any questions that you have here? We extend the date for the tutorials. Any of you have a question? I'm still asking here whether you have a questions or not. No questions, so you try to do this one once again. Okay, and then try to answer your tutorials questions. Yeah? Okay, so for since there is no questions, I'm going to end the meeting in few minutes. Okay, so for those who want to leave the meeting, can leave the meeting. For those who want to ask a question, I'm still be around for